Okay, so we have something to talk about before we get to homework today. So we have today's class. On Monday, we're going to start chapter 17. Then if you notice in the syllabus, I have in-class activity listed on Wednesday. So I have a few things that I want to discuss with that. So with respect to the in-class activity, my intention is that I have a teaching case that I developed with a former Truman student. And it's usually what I would do on the Wednesday. It's kind of a reflection of the audit risk model. I will be honest, I'm not terribly enthusiastic about it right now. I don't know how important or relevant it is since we've already covered audit risk. So I've got a few options for you. And I want, before we say this, okay? I want to come to an agreement, a consensus with the class, all right? And if you disagree, then I'm just gonna chop the Gordian knot and say, all right, well, then we're doing the in-class activity because I don't want any consensus. But whatever the class agrees to, can we say that everybody in the class will agree? Even if that was not your personal preference, you will agree to what their class agrees to. Can we come up with that? Okay, all right. Because I don't want to have this afterwards be a point of contention. Because if this comes up on my evaluations, I will hunt you down. You say these are anonymous, Dr. Barnes. You can't tell. I will find out. Okay. Process of elimination. I will find out. So here's what I'm proposing. Okay. Here's what I'm proposing. Let's go ahead and present. So here's my poll everywhere. You can be anonymous in this. You don't have to tell me. So what you prefer to do? The first one is basically what we're going to do in the first place. Okay. Okay. I prefer to take part in an in-class teaching case. That's the first activity. All right. The second option is that there's an audit documentary that I actually really like that we could watch as a class and do that during the 15 minutes. Or since this is right before fall break, you could say, I prefer not to have class on fall break. Either of these any of these options are fine. I don't particularly care which, but whatever the class settles on, we will all agree to. All right. Funny part is if it's 100% all that, I know exactly what everybody answered if that's the case. Yeah. Watching the poll everywhere is like this. The problem is there's also a confirmation bias. Like this happens when I do poll everywhere in classes. Everybody just waits until the poll everywhere is up and then they just answer what everybody else answered. And so yeah, it's definitely here. All right, are there any more responses? Anything else on up here? All right. All right, so I want to clarify that we have agreed as a class not to meet on Wednesday. Are we consensus of that? This is not Dr. Barnes cancel class and I want my money back. All right. If I get any of that on the evaluations, again, I will find out who you are. Okay. And you basically will not graduate. All right. Yeah. Obviously, so yeah. Yeah. So I just want to confirm this was what I was going to lean towards. I was going to say a cancel class, but again, I want to make sure that this is something that we decide and not something that I decide. So we're all clear with that. No class on this coming Wednesday.
And we're not telling this.
Well, I'm recording right now, so I'm assuming he's watched the video. Say, Hudson, how's it going? We may give away your points on today's homework assignment, but you don't have to come to class on Wednesday. Yeah. All right. All right, so let's go ahead and do some homework stuff. Homework should be short and to the point, I think, so we may get out here a little bit early. Maybe it depends on how much I feel like talking. So question 719, the Sarbanes-Oxley Act of 2002 requires management to include a report on the effectiveness of internal controls or financial reporting in the entity's annual report. It also requires auditors to report on the effectiveness like offer for large public companies. Which of the following statements concerning these requirements is false? All right, the auditor should evaluate whether internal controls or financial reporting are designed to operate effectively. What do you guys think? Is that true or false? That is a true statement. That is a true statement. Management reports to state responsibility for establishing and maintaining an adequate internal control system. That is also a true statement. Management should identify material weaknesses in its report. Well, yeah, they're responsible for making sure that they state all aspects of the internal control system. So we got one left. Let's hope that's the wrong one in this case. The auditor should provide recommendations for improving internal control in the audit reports. Okay. Does the auditor have responsibility for providing recommendations to improve internal control? They do have that responsibility. Do they provide that in the audit report? They do not. Okay. This is not something that's disclosed externally. This is something that we confirm with managers about. Remember that list of control deficiencies that we identify? So all those control deficiencies are communicated to management, and the audit committee knows about that communication, and those represent a list for improvements in control. So recommendations for those improvements. So the auditor will provide that, but they will not provide it as part of their report. So that's our false statement in that situation. A control deviation caused by an employee performing a control procedure that he or she is not authorized to perform is always considered a what? All right, so let's go ahead and eliminate a couple of these answers right away. All right. Always is a really, really powerful word, so we need to make sure we're in situation. So is it always a significant deficiency? No. Remember that significant deficiency operates on the order of magnitude. And so if it's a very small issue, then we just consider it a regular control deficiency and move on. So it won't always be a significant deficiency. By that logic, it also will not always be a material weakness. So it's always going to be a deficiency in design or deficiency in operation. What's the difference? Deficiency of design is saying the control is not present, or the control is not well designed to address the issue that's in place. Is that what's going on here? No, we have a control in place, and if the control is observed, it looks like the control would be effective. So this must be a deficiency in operation. The control is designed properly, but for some reason, whoever's responsible for that control is not doing their job. Therefore, the control cannot operate effectively. So B is our answer. 723, which of the following controls would most likely be tested at an interim period? So keep in mind, we talked about interim testing. We talked about the nature of interim testing, and interim testing basically says that we want to actually have controls that are recurring and will maintain operations in a certain manner for the remainder of the period. So we want something that's going to be consistent, predictable, and not susceptible to change. All right, let's go ahead and go through our answers. Control over non-routine transactions. Is that consistent and predictable? Probably not. Non-routine kind of implies that it's not consistent and predictable. Controls over the period end financial reporting process. So should we test something that occurred that's relevant to period end at interim? I think that's kind of contradiction in terms right there, a contradiction analysis. Controls that operate on a continuous basis. Yeah, continuous basis implies consistent and predictable because they're going to be doing the same thing. So C is probably our answer, but let's go ahead and go to D. Control over transactions that involve a high degree of subjectivity. So subjectivity, basically kind of the nature of subjectivity says that we can't predict it because we don't know it. It's very volatile and it's subject to personal interpretation. So D is not going to be our answer. So C, pretty clear answer in this one. 728. In auditing a public company, Natalie, an auditor for NM Neal and Associates, identifies 4 deficiencies in ICOFR. 3 deficiencies are unlikely to result in financial misstatements that are material. One of the deficiencies is reasonably likely to result in a material misstatement that are not material, but significant. What type of audit report should Natalie issue? All right, so let's answer this question in parts. What type of deficiencies are the first 3 that we represent? So probably control deficiencies. They don't really use the language really well because they say it's not material, but it could still be significant, but likely control deficiencies. The fourth of these basically says reasonably likely to result in misstatements that are not material, but significant. So what type of deficiency are we looking at here? Is this a material weakness or a significant deficiency? It's really important because if we don't know the difference between those two, then we can't answer this question. So result in misstatements that are not material, but significant. So we're going to be significant deficiency or material weakness? Significant deficiency. Remember, that's how we categorize a significant deficiency. It's not a problem now, but would be a problem if left unchecked. Significant, but not material. So this is significant deficiency. So 3 control deficiencies and a significant deficiency. All right. All right. So let's go ahead and let's actually throw out this exculpatory opinion. That's something they made up that doesn't really relevant. Could it be a disclaimer of opinion? What would a disclaimer of opinion specify? You don't know what's going on. It's a scope limitation. We can't do our job. Okay. Is that what's happening here? Was Natalie able to do her job? Yeah, she was able to do her job. So it's not a disclaimer opinion. So it's either going to be an unqualified opinion or an unqualified report or an adverse report. Okay. One of those two. It can't be a qualified because there's no such thing as qualified for ICOFR report. So it has to be one of those two. What do you guys think? Unqualified or adverse? Unqualified. Remember, adverse has to specifically have material weaknesses. Material weaknesses are required for an adverse opinion. There are no material weaknesses in this particular situation, so it's going to be an unqualified opinion. Does that mean that it's going to continue to be an unqualified opinion if nothing changes? Probably not. That significant deficiency keeps recurring. We'd say we may upgrade that to a material weakness. All right, 730. Which of the following statements concerning control deficiencies is true? Boy, I hate questions like this. Why did I assign it? All right. Auditors should communicate to management in writing all control deficiencies and internal control identified during the audit. Okay. What do you guys think? Is that a true statement? That is, in fact, a true statement, but let's go ahead and go through the rest. All significant deficiencies are material weaknesses. No, they're not. There's a difference there. All control deficiencies are significant deficiencies. Nope, difference there too. An auditor must immediately report material weaknesses and significant deficiencies discovered in the audit to the PCAOB. We were so close. What are the words there that do not belong? Significant deficiencies. We do not report significant deficiencies externally. Okay, those are internally only. All right, moving on. Chapter 8. Samples to test internal controls are intended to provide a basis for an auditor to conclude whether the controls are what? Okay, whether controlled what? I guess I kind of spoiled that because I basically said whether the controls are operating effectively. So that makes intuitive sense because we're trying to answer a yes/no question. And remember, we identify a sample. It's usually going to be attribute sampling, which determines whether or not a particular feature exists. When we're testing internal controls, we're not testing financial statements directly. We're not testing balances. We're not specifying risk of incorrect acceptance is too high, and we're not determining anything materiality. So the only thing that's relevant is A here. Which of the following combinations results in the greatest decrease in sample size of an attribute sample for a test of controls? All right, so we're talking about something that would decrease sample size. So let's go ahead and talk about these individually. Let's talk about these individually. So remember, we talked about multiple factors. Confidence level. Is confidence level directly... somebody really likes confidence level. Yes, confidence level. Woo! Nobody gets excited like that in my class. Yeah, all right. I'm teaching auditing. All right. Confidence level. Is the confidence level inversely or directly associated with sample size? So it's a direct association. So if confidence level goes up, sample size go up. If confidence level goes down, sample size goes down. So we're probably looking for a decrease in confidence level, which means that we can eliminate B, okay? Tolerable deviation rate, expected population deviation rate. Remember, we consider those together, okay? But if one moves and the other stays the same, then it's going to change the distance between those two, okay? So what is the relationship? Let's first of all talk about the relationship between the distance, okay? So the distance between these two, is that an inverse or direct relationship with sample size? Inverse. So remember, the bigger this distance is, the bigger the difference is, the smaller the sample size is. And if that difference gets smaller, then we have to increase our sample size. So if tolerable deviation rate goes up, that means that our sample size goes down. If expected population deviation goes down, then that means the sample size also goes down. So we're looking for something to increase and decrease here. So C is our answer, okay? Now answering these questions, again, tolerable deviation rate, expected population deviation rate, we consider those in context to one another. So basically we're talking about if one changes and the other stays the same. So that's how you'd think about these particular items. 819, this may be my favorite question in this homework assignment. Oh, maybe not. Yeah, 819 is my favorite question in the entire homework assignment. I love this question. Assume an auditor is evaluating statistical attribute sample of 50 items that resulted in 3 deviations. What should an auditor conclude if the tolerable deviation rate is 7%, the expected population deviation rate is 5%, and the allowance for sampling risk is 2%? All right. So we're trying to conclude on whether the controls are operating effectively. And we have all the information we need up here, whether we believe it or not. Okay. So what is it that we're trying to compare in this assessment? Okay. Let's do the easy one. Do we include tolerable deviation rate? Yes, that's our first consideration. We're trying to determine if something is greater than or less than tolerable deviation rate. If something, which we'll determine in a second, is greater than tolerable deviation rate, we conclude the control is not effective. If something is less than tolerable deviation rate, then we conclude the control is effective. Now, what is that something? Well, remember, we talked about the expected population deviation rate. That was the calculation, the expected population deviation rate. All right. That was, sorry, is that right? No, it's not right. That's not right. Upper error limit, that's what I'm talking about. I don't remember what the other terminology was. So We basically upper error limit, upper sample deviation rate, upper population deviation rate. That's what we're talking about. So we do the test and we observe that there's a certain amount of deviations, and we assume that somewhere around that range is what we believe is going to be the deviation in the sample. Now, in this particular scenario, we had 3 deviations in a sample of 50. What is our sample deviation rate? 6%, 3 divided by 50, okay? So it's going to be somewhere around 6%, somewhere in a range of 6%. Basically, we would add on a certain number, that's our allowance for sampling risk, to compute the highest possible limit, the highest possible deviation rate. In this case, it says the allowance for sampling risk is 2%. So 6 plus 2 is 8%. We compare that 8% to our tolerable deviation rate of 7%, and we said that that number is higher than our tolerable deviation rate. Therefore, we have to conclude that the control is not effective. Now, basically, all that terminology is trying to break down what is the answer that actually depicts that particular scenario. So in D, it says the planned assessed level of control risk should be modified because the sample deviation rate plus the allowance for sampling risk exceeds the tolerable deviation rate. So the 6% that we noted 3 deviation rates of 50 items plus 2%, that sample allowance risk, our allowance for sampling risk, exceeds the tolerable deviation rate of 7%. Now, this is important to remember. When we talked about this on Wednesday, this is what I reiterated. Does that mean that the actual population deviation rate is 8%? No, it means that we're speculating it's somewhere between 8% and some percent below 6, some range, maybe like 4 to 8%. We're just determining what is the highest possible level that population deviation rate could be. And if our tolerable deviation rate is higher than that, what we can tolerate is higher than that, we can fully conclude that we're okay with that, the test to control. But if that highest number is greater than our tolerable deviation rate, we have to conclude the control is not effective. And if a control is not effective, what does that tell us about control risk? Control risk goes up or down when controls are not effective. Control risk gets higher, okay? If control risk gets higher, then we have to change our assessed level of control risk, okay? We have to change our assessed level of control risk because control is not operating effectively. Excellent question. Test multiple concepts simultaneously. This one's not an excellent question. Which of the following sampling methods would be used to estimate a numeric measurement of a population such as dollar value? Well, we only talked about 2 sampling methods. We talked about attribute sampling and variable sampling. Attribute sampling is answering a yes/no question, just basically saying, does an attribute exist? So the other one has to be variable sampling. That's where we extrapolate a number based on what the results of our misstatements in a sample, okay? Which we looked at an example of that on Wednesday. This one's a little bit better. How would it increase in tolerable misstatement in the assessed level of control risk affect sample size in a substantive test of details? So these are kind of quantitative concerns that we've talked about a little bit already. So let's just go ahead and analyze these individually. If I have an increase in my tolerable misstatement, so I basically am performing my test work. I originally assessed an account to have a tolerable misstatement of $10,000. Then I look at the account and I say, you know what? There's not as much risk in this account as I originally thought. I'm going to reassess this amount at $15,000. Is that going to increase the sample that I have to look at, or is that going to decrease my sample?
Decrease.
It's going to decrease my sample, yes, because if I have a higher misstatement, I can look at fewer items because I'm less concerned about errors. Okay, that goes back to that idea. Remember, we originally talked about materiality, and I said, do we want high materiality or low materiality? The higher materiality is the better because we have to do less work. So tolerable misstatement is inversely related to sample size. The higher that misstatement is, the smaller our sample is. Our sample needs to be. Higher that tolerable misstatement is, the lower our sample needs. So it's going to be decrease. And then we're going to talk about the assessed level of control risk. Okay, increased assessed level of control risk. So this is the preliminary level of control risk. We're looking at our assessed level of control risk. And we're saying, we don't think controls are going to be very good. What does that mean about the work that we have to do subsequently, our substantive tests and procedures? Are we going to have to do more work or less work? More work, so that would be an increased sample size. We have to increase our sample size because we think controls are not as effective, which means that the subsequent work we have to do later on will be larger. So answer is B, decrease sample size and increase sample size here for these 2 respective items. All right, let's walk through some problems. All right. So it tells you to look at the William Wilson Adams policy statement on value and control deficiencies. It's actually not that hard. We're going to analyze based on significant deficiency or material weakness. Now, again, this is what's given in the case. I do want to reiterate that you do need to think about this from both a perspective of magnitude, likelihood, and magnitude. On the exam, if I ask you a question of this nature, I will ask you on both dimensions. So you will have to evaluate not only what's a possibility of a control deficiency, a significant deficiency, or a material weakness, there's a possibility it may not be a control deficiency at all. This one only gives one of two options, but we're going to spend some time making sure we understand what happens in each situation. So A says the entity uses a standard sales contract for most transactions. Individual sales transactions are not material to the entity. Sales personnel are allowed to modify sales contract terms. The entity's accounting function reviews significant or unusual modifications to the sales contract terms, but does not review changes to the standard shipping terms. The changes in the standard shipping terms require a delay in the timing of revenue recognition. Management reviews gross margin on a monthly basis and investigates any significant or unusual relationships. In addition, management does other stuff that's a redundant control. Inexperienced limited situations in which revenue has been inappropriately recorded in advance of shipment, but amounts have not been material. This is about as clean cut as it gets. Is this going to be a significant deficiency or a material weakness? What do you guys think? Staring at me won't change your answer. Significant deficiency. Okay, so we have a couple of points that actually mentions that the transaction amounts are not material. Okay, now could they be material in aggregate? Possibly. All right, possibly. It doesn't really allude to that. That's going to be relevant to some discussion we'll have later. But we also note that management has appropriate controls in place that are redundant to kind of address these problems. So if the control itself fails, management does have reviews of the process. So it's very unlikely that the control itself is going to have a material misstatement. If anything, it's just going to be significant. I would argue that probably that's even a stretch, that probably we would just look at a control deficiency in this area. But regardless, it only gives us two choices, significant deficiency or material weakness. So we're going to say significant deficiency. The entity has a standard sales contract, but sales personnel frequently modify the terms of the contract. Darn sales personnel. The nature of modifications can affect the timing and the amount of revenue recognized. Individual sales transactions are frequently material to the entity, and the gross margin can vary significantly for each transaction. Ooh, the entity does not have procedures in place for the accounting function to regularly review modifications of sales contract terms, and if management reviews gross margins on a monthly basis, significant differences in gross margins on individual transactions make it difficult for management to identify material misstatements. Improper revenue recognition has occurred. Amounts have been material. So remember how I said in the first one that's about as cut and dry as they get? This one's also pretty cut and dry, but for opposite reasons. All right. Is this going to be a significant deficiency or a material weakness? Material weakness is about as clean as it gets. This will probably be not as clean, or what I give you on the exam will not be as clean as this. So if you don't understand this one, make sure you understand it now when I'm talking about it. So we have transactions that their misstatements are frequently material. It mentions that multiple times. Moreover, management does not appear to have redundant controls in place, either through the accounting process or their own personal review. They do try to review it, but it looks like that the nature of the transactions make them difficult to identify misstatements. So it doesn't really serve a purpose. So this is about as easy material weakness as you get. The entity has a standard sales contract, but sales personnel frequently modify the terms of the contract. You know, you think in the Part B, we identify them doing that. We'd stop them from doing it in Part C, but no, they just continue doing it. Sales personnel frequently grant unauthorized and unrecorded sales discounts to customers without the knowledge of the accounting department. These amounts are deducted by customers in paying their invoices and are recorded as outstanding balances on the accounts receivable aging. Boy, that would make me mad as a customer. You know, it's like saying, what is my balance? Oh, you've got $1 million balance. What? I paid off everything. It says, yeah, well, those discounts, we didn't really like them. Okay. We didn't really appreciate your discounts. Although these amounts are individually insignificant, when added up, they are material and have occurred regularly over the past few years. This one is very subjective. Okay. This one's a little bit more subjective. A and B, very clear answers. This one is a little bit more of a challenge. What do you guys think? By the way, it doesn't, when I'm saying think, I'm literally asking, what do you think? Because either one of these answers would be correct, but you have to justify your position on this. So
I said material weakness because it happened over the past few years.
And the book agrees with you. The book agrees with you. I do too. I do think it's a material weakness, but again, I'm giving everybody benefit of doubt. If you said significant deficiency, you can make an argument for that. The strongest clues that probably lead to a material weakness is the fact that when added up, they are material, and this does occur so frequently. It doesn't appear that they have controls in place stopping them from basically kind of ripping off the customers, because customers are not actually getting a discount. It's just being added to the allowance for doubtful accounts, saying, well, it's uncollectible. which kind of is not a good position for an organization to be in. So I do think that this one leans heavily towards material weakness, but not nearly as heavily as we talked about Part B. You could make an argument for significant deficiency, but material weakness is where I'd go on this. All right, that was fun. What do you guys think? Was it fun? Do some more? Yeah, okay. While we're here, since we're not going to be here on Wednesday. All right. So during its assessment of ICOFR, the management of Low-Range corporations and its auditors identified the following control deficiencies that individually represent significant deficiencies. All right. Inadequate segregation of duties over information system access controls. All right. Inadequate segregation of duties. That's the most material of weaknesses right there. We already know that. Violate that and you've offended Dr. Barnes. Okay. Several instances of transactions that were not properly recorded in subsidiary ledgers. While the transactions weren't properly recorded, probably were not material. The gross amount of the transactions that type total up to amount several times materiality. A lack of timely reconciliations. The account balances are affected by the improperly recorded transactions. All right. This one's very similar in nature to Part C. What did we complete with Part C in the previous one? We said it was probably material weakness. I would think that this one probably meets that criteria too. I would say that this is probably material weakness too. If we look at just the first one, inadequate segregation of duties, that ticks me off, okay? But that in itself is not enough to indicate a material weakness. But we start looking at recorded amounts that were not material, but in aggregate, they were material, several times materiality. And there doesn't appear to be any follow-up to try to prevent this from happening. So I think this leans also towards material weakness. You could make an argument for significant deficiency, but it would have to be a very good argument for that. All right. I think, yeah, this one I like. This one's just kind of outrageous. During its assessment of ICOFR, management of First Coast Bank Corporation and its auditors identified the following deficiencies that individually represent significant deficiencies: the design of controls over estimated of credit loss, a critical accounting estimate, the operating effectiveness of controls for initiating, processing, and reviewing adjustments for the allowance for credit losses, and the operating effectiveness controls designed to prevent and detect improper recognition of revenue income. In addition, during the past year, First Coast experienced a significant level of growth in the loan balances that were subjected to the controls governing credit losses and estimation of revenue recognition, and further growth is expected in the upcoming year. So let's think about what's happening here, all right? It appears that these items have kind of been recurring over the past few years. If we were talking about in year one, we probably as auditors say, look, these are significant deficiencies and these need to be fixed. So we're probably issuing a clean opinion with the caveat to management, say, take this seriously, get it fixed. Year two comes around, say, hey, these issues still exist. They're not a problem yet. You probably don't have any material misstatements, but you're likely to have some if you continue growing at the rate you're growing. Year two, clean opinion. We're now in year three. Year three, they're still growing, and it looks like further growth is expected in future years. As the auditor, you've had this problem that's been occurring. You've told management twice to fix the problem, and they haven't. What do you think? Obviously, I'm making you trying to reach to a specific conclusion. Can we agree that this is probably, even though by definition, this is not a material weakness, given the circumstances, given this situation that we've identified in this particular question, that we can conclude that in aggregate, this is probably a material weakness? I hope so, because that's where I'm trying to get you to, okay? If you don't buy that, then I don't know. We're gonna have to repeat the semester, I guess, all right? So we don't want that. So we're going to conclude that, yes, this is the van that's been driving and I'm saying, I don't have any oil in it. It's not a problem now. 20 miles down the road, still not a problem. 100 mile down the road, still working. 1,000 miles down the road, that thing is not going to be working anymore. We're now 1,000 miles down the road. We have to say, look, you guys have had multiple chances to fix this problem. You haven't yet. Material weakness. That's kind of the conclusion we're at right now. That's the whole point of reporting significant deficiencies, is so they don't keep recurring year after year, that they fix that problem. All right. Moving on, question 8, Eric, 825. So, oops, problem 825. All right, we got these again. So we did these on Wednesday, but I had you do these on your own. Anybody just try to crank out idea and do the calculations in idea? Say, you know what? I know we're not doing idea, but I want to make Dr. Barnes proud and I want to do these questions in idea. What? Nobody? Yeah, I want it. All right. Let's go and plug in some numbers, shall we? All right, so 825 is asking, given these criteria, what is going to be our sample size? So I should probably not put it on the answer if I'm going to put it up there. Okay, so sample size, Control procedure number 1, risk of incorrect acceptance of 5%. What does that mean of confidence level? 95%. Yes. So 100% minus whatever that number is. So 95%, tolerable deviation rate of 4%, 1%, sample size of 156. We have a correct answer. Good. All right. All right. Same confidence level because our risk of correct acceptance has not changed. Tolerable deviation rate of 5%, expected population deviation rate of 2%. This is interesting. So the distance between those two has remained the same. So we probably are looking for a sample size that's going to be pretty close to this. It's going to be pretty close to 156. Now, it won't be the same because statistics is weird, but can we assume that it's probably not going to change that much? Probably so. Let's go ahead and check and see. 181. All right. So not bad. Not bad, all considered. I would have expected it to change less, but still, even so. All right. Let's move on. 10% risk of incorrect acceptance, meaning a confidence level of 90%. Okay. Tolerable deviation rate of 7%. Expected population deviation rate of 3%. So we got a sample size of 94. Good. And then 10%, 8%, 4%, 4% distance here. So we expect our sample to probably be pretty close to the previous one. And in fact, it is 98. So let's just go ahead and put those down here because now we're going to do our calculations for our auditor's conclusion. All right. So in the first test, I have 156 items and all of them were effective. All observations were effective. Okay. So our sample deviation rate is very cleanly a 0.0%. So does that mean the entire population is cleaned with 0%? We can move on with our lives? We hope that we can move on with our lives, but we've got to do some analysis, okay? We've got to do some analysis. So the computed upper deviation rate, what did you guys come up with in that particular problem? 2, yeah, 2.0, okay? So 2 plus 0 is going to be 2%. Our tolerable deviation rate is 4%. So what do you guys think? Yeah, we accept it, okay? That is an effective control. An effective control. All right. Number of deviations is 5 on 181. 5 divided by 181 is 2.8%. Computed upper deviation rate of that is going to be what? I got 6.9. Did anybody agree with me? Let's take a look. I can remember where the sample attribute sampling tables are. There we go. Okay, 5 deviations on a sample of 181. Remember, we always go to the higher level, so we start at 150, even though it's closer to 200. The answer is probably closer to like around 6, but we're going to start 6.9. Doesn't really matter what that number is because that number is so incredibly large relative to the sample deviation rate. It doesn't matter if this was 6 or 6.9. It's still greater than 5%, the sum of these two. So we conclude it's not effective. This is one of the reasons why we'd want to use IDEA here, because we'd like to have this number be a lot more precise. 181 is kind of in the middle of 150 and 120, or 150 and 200. So that's kind of a problem. This is a little bit more precise. So 94, 4 divided by 94 is going to be 4.3%. Computed upper deviation rate, again, we had to go to the second table, so that's going to be 8.7. That's not necessarily precise, but we don't need it to be because 4.3 plus 8.7 is like, what is that, 13%. 13% is a lot greater than 7%. So we're going to say not effective. And then we have 3 divided by 98. It's going to give us 3.1%. What about our computed upper deviation rate? Some point, I think I'm adding these together and I don't mean to add these together. I shouldn't be adding these together. I've added these after the fact. So my apologies. 6.9 is greater than 5. 8.7 is greater than 7. My apologies. I shouldn't be adding these together. I don't know why I started thinking that way. Apparently it's Friday. All right. So upper deviation rate, this is going to be 3.1% plus the allowance for sampling risk equals 7.3%. Tolerable deviation rate is 8%. 7.3% is less than 8%. So we conclude the control is effective. There we go. Apologize. I got a little bit carried away. I was so excited about adding numbers together and didn't think about it. This is not the allowance for sampling risk. This is the amount that includes the allowance for sampling risk, which is given on the table. My sincere apologies for that. All right. With that, we're done for today. We will be back on Monday for chapter 17, and we'll see you all then.